Right? As I mentioned, this is being recorded. One thing I also mention at the beginning of every single webinar is watch this again. You don't have to watch this exact one on synthetic short stock, but this is going to be really geared towards a directional bias. Maybe if you're newer to options trading, there's some more basic option strategies you could look at. Also, some of the ones that are more basic, I will go into a little bit more detail about the short stock, synthetic short stock implementation. So on this one, I'm going to kind of assume, now that we've gone through this course for quite some time, some of those basic ideas that I usually bring up are going to kind of get brushed over a little bit. But if you are newer to options trading and I brush over something or breeze over something a little too quickly, feel free to reach out to me in the questions box over there, because I'd rather have everybody clear a concept before we move on. I'm not going to make you wait to the end of the webinar to start asking questions. I want to make sure everybody has those questions figured out so that you're not dwelling on that and getting lost throughout the rest of the webinar. All right, so like I mentioned, this is for a bearish directional assumption. First thing we usually do when we're looking at charts or watching TV, CNBC, whatever news channel you watch or business channel you watch, you come up with assumptions. Maybe you even saw a new product out there, Beyond Meat, and decided that you have a directional assumption with that. Well, that's the first step in just about every assumption, right? Is we come up with a directional bias. And then what we need to do is figure out what environment and everything else fits with a particular strategy, all right? So that's what we're going to be dealing with. We're going to come up with a directional assumption. The assumption today is obviously we have a directional bearish bias, which might very well be throwing darts at the dartboard right now and just hitting about any stock, because with a bearish that we've seen in the market recently, it might be a pretty pertinent time to start implementing something like this. Let me get a couple of things out of the way though real quick. My name's Eric Wilkinson, and yes, you may recognize me as the Wolfman from mainstream media. But what happened was I started trading in college with a psychology degree and decided to switch it over to finance. And after graduating college with that finance degree, I literally moved to Chicago, never even built a resume, walked onto the floor, got a job, and have been trading ever since. In that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. Please remember that any opinions, news, research, or analysis or other information contained in this webinar is not construed as investment advice, all right? I might be even talking about stocks that I have in my portfolio. I'm not trying to get you guys to lemming off the cliff with me. What I'm here to do is teach you guys how to swim. I'm not here to swim for you. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can also follow me on Twitter at Wolfman's Blog, or our parent company at ProTraderStrat for any kind of market wisdom. We're also really pushing our Facebook page right now, and that's at ProTrader Strategies. You get a lot of the daily market commentaries and things of that nature on there, and some free content. So check that out if you want to follow along with that. And those daily market commentaries, you guys, I talk about every single trade I do, when and where I put them on, when I take them off, win, lose, or draw. I'm not cherry picking anything. I'm not saying, had you done this strategy when I said you would have made this much money. I'm a lot of times even saying, well, you know, this one's a loser, or this is how we're going to manage some of this risk that might be going against us. So all of that stuff is really about portfolio management too. So it's not just talking about how to build a strategy. I talk about how to implement that strategy and how to manage that risk as we're going along. You know, I mean, I'm doing it on a day-to-day basis, and I'm just letting you guys in on it all. All right, synthetic short stock. I mean, what is that? Really what we're doing is we're taking options and we're building a position that is equivalent to a short stock position. The beauty in using options is that there are all kinds of benefits. It's going to cost us a lot less. We're not going to have to deal with some of the other negative factors of going out there and finding a stock to short, all right? Or even just adding a short stock position to our portfolio. So this is great for overbought stocks. Let's say the market's really rallied and you're a contrarian. You will find that I am very much a contrarian. I don't believe anything can continue to go up indefinitely. So I like that, this strategy for that type of assumption. Also, if you just have a bearish assumption, you see some news out there. I mean, Tesla even came out today, or actually an analyst came out today and basically gave a sell rating or overvalued rating on Tesla because they weren't meeting production for one, and there was a feeling that there was a lack of demand for the products that were already out there. Basically, every millionaire's already got his Tesla, and it's hard for the middle and lower classes to buy a $100,000 car. All right, so it's great for a bearish assumption, however you come up with that. Converting an option into a bearish put position reflecting a stock. Yes, and it's not just puts. We're going to have calls in there as well, but what this is going to do, a lot of times if you just go out and buy a put or even sell a call, then you aren't going to get that dollar for dollar move downwards to match your assumption. So if you thought it was going to be a little bit of a quick move or anything kind of bearish around that, we're going to be able to build this out. So it is like dollar for dollar selling 100 short, say Tesla. So for every dollar Tesla would move down, our position would increase in value by that same dollar. All right. And this is great for bearish markets. Pairs trade. So if, for instance, you wanted a pair at Deere against Caterpillar, those are very similar stocks, and you wanted to create that type of hedge, then you could do that very easily by using this type of synthetic short stock position. And for portfolio delta adjustment. And what does that mean? Delta adjustment. Well, if you have a portfolio of all long stocks, that means you're beholden to the market going up, right? Or all of those stocks going up. And there is always a case for a bearish assumption in any given underlying. Even if the market is going to all-time highs, there's stocks out there that are struggling. And that is the time to add some of those short deltas. It gives you a more neutral stance in your portfolio. If it's all positive, then you have to have the market go up in order to make money. If you are going to add some synthetic short stocks in there, then that will hedge or adjust the deltas in your portfolio. All right. So if, for instance, delta, if you're long 100 of XYZ stock, that means you are positive 100 deltas. Well, in a market like we're seeing right now, where it's a bit of turmoil going on, for lack of a better phrase, the thing to do would be to add some short deltas to your portfolio if you're a little bit worried about the downside, so that you can capture some of that movement to the downside. It won't hurt your portfolio nearly as much. All right. It's the same risk as a short stock position. Now, you've heard a lot of times on TV and stuff like that, selling short is risky business. And that's only because the assumption is the market is always going up. If you ever watch TV, all they want is the market to go up, and it doesn't always work that way. The market has corrections, all right? But knowing that if you're creating this position, it is the same risk as a short stock position, dollar for dollar. If the stock moves up and you're short a synthetic short stock, you're going to lose dollar for dollar, all right? But the positive here is that you can use about 50% less buying power. If you go out and short a stock, you're going to have to put up the entire amount of that. And with the synthetic stock position, you're using options. So your buying power is going to be much less. Your margin is going to be much less. At least that's here in the United States. Canada and some other countries will have some different rules for options trading. But, I'm assuming here in the United States that it's going to be what it is, and that's about 50% less buying power. And because we have less buying power, or using less buying power, our return on capital is much better, all right? You can think about a return on capital is how much you put up in order to achieve the same amount. So if I put up 50 cents to achieve the same amount as something I had to put up $1 for, well, then my return on capital when I am successful is much less. All right. And you avoid the borrowing fees. Now, another thing is a reason why people don't go out there and short stock. For one, it's a lot of work. Two, you're going to have to borrow that stock from somebody that already owns it. They're going to loan it out to you. All right. And you're going to have to pay some borrowing fees on that. All right. It may be even bank fees that are involved in there. We want to avoid all that. To be honest, I have never gone out there and borrowed stock from somebody and dealt with all of that rigmarole that you have to deal with. The best way to do it is to go out there and use these options in order to achieve the same thing. Why would I go out there and put up more money, risk more money, have less return on capital, have all of these fees that are associated to it, when I could just go out there and easily go into the option montage and create the same type of position, right? And it's easy enough. I mean, it's really one of the most simple things we can do. And building a synthetic short stock position, we're buying an at-the-money put and then selling an at-the-money call. Now, that short at-the-money call is where our risk is dollar for dollar to the upside, all right? So that is, you know, what makes it a little bit scary for some people. And it might not be appropriate for an IRA. As a matter of fact, IRAs won't let you do that short call. There's ways to get around that. We can go out and buy an out-of-the-money call to cover that risk to the upside. And I will talk to you guys about how to do that as well. Remind me once we start building it out so that I don't forget. But we can just buy like a call for a nickel, and that meets the rule and regulations of having a short call in our portfolio, and it's going to be like a naked short call anyway. Never rely on that defined risk aspect, that out of the money call that we would be buying in this situation that I'm referring to, because it is, we would never ride it out to that point. At least I wouldn't, and I hope you would not either. And I'll talk about risk management of getting out of this and when we get out of that, when we get to it. So let's just say we came up with a bearish assumption in XYZ. I don't know what that stock is, but let's just say it's XYZ. I have to know that it is an underlying that is worthy of trading options, all right? Now, there's stocks out there that people will often refer to, let's say AutoZone. You see those every day driving down the street. Aon is another example that don't really fit my rules for being able to trade options around that. So one of the first things that we're going to have to do is pull up this option montage over here. And this is what I'm referring to as the option montage. It basically has all of the strikes every single month that is available to trade. And that's what we're going to be looking for. So for this rule, what we want to do is look at XYZ, and in this case, it's Kroger. And we're going to go to the closest to 35 days to expiration is usually the wheelhouse. 15 days to expiration, people are stopping or are going to be slowing down on trading these options and rolling out into the further duration, okay? So we're going to be looking at the option montage that has closest to 35 days to expiration, and we can say that 8 days away is pretty darn close. And the negative 50 at the money short call is close to the 50 delta at the money call, correct? So he's referring to how we're building this out right now. John's referring to how to build this out. And we're not always going to have that negative 50 delta. And what we need, and I'll talk about that here in a minute, a little bit more detail. But what we want to do is any stock that's under $50, Kroger's under $50, we need to make sure that our option montage is reflective of having less than 10 cents wide. We want less than 10 cents wide. Let's throw a dollar sign on there. Less than 10 cents wide to the bid offer. And that's coming down here. Just these out of the money options. Further in the money, you can see that it won't fit that rule, but we want less than 10 cents wide to the bid offer here. You can even look at the puts over here, less than 10 cents wide. So this stock is under $100. It fits this rule. Therefore, I would say that it is an option an underlying that is option tradable. All right. Now we look at a stock that's over $100. So this is any stock that's greater than $100. Then what we're going to do is move this decimal place right there 3 ticks to the left. So we go 1, 2, 3, and we come up with 27 cents, right? So we need to look back down here to these options that are just out of the money, and you can see that this fits that rule as well. Those are definitely from the bid to the offer inside of that 27 cents. It's very close, but it fits that rule. That means we could say that Adobe, if we had a bearish market assumption in Adobe, that it fits that rule, that it is equal to or less than 27 cents to the bid offer on any stock that is greater than $100. So you will see that as those stocks increase, even to the size of Netflix and Google's and Chipotle, those will, during open market operations, that means while the market's open to trade, then we are looking at the option montage for this rule. Outside of the close, we've just closed. We're after the close usually when I'm doing these market commentaries. The markets will have a tendency to be a little bit wider. And the reason why they get a little wider, think about it. When you have trades on, whether it's a stock or an option, as soon as that bell rings, you just see all of a sudden in your working orders, they all get canceled, right? Well, when they're all getting canceled, the market's much thinner. It means there's not a whole lot of participants left in there. Well, only the crazies will leave those orders in there for extended period of time, as far as I'm concerned. Not really crazies, but they have a very high risk tolerance if they're leaving them in there overnight and for eternity. Okay, so the markets will generally have a tendency to get a little bit wider. All right, is everybody clear on that concept so far? So if we're picking the right underlying, what we want to do is look at this as if the stock is less than $100, then it needs to be equal to or less than 10 cents, okay? And if it's greater than $100 on this XYZ stock, then it needs to be equal to or less than, moving that decimal 3 ticks to the left, all right? We move that decimal 3 times, whoops, starting out there in 1, 2, 3. So if it was, let's say, a $200 stock, then we move that decimal 1, 2, 3, okay? So it'd be 20 cents. So equal to or less than that rule there. John, I'll talk about those deltas here in just a second. And as a matter of fact, we can probably get to that right now. Picking the right strikes or the right strikes for this. Well, we already mentioned this once, right? It was that we're doing the at the money. So that's pretty simple. And if we're worried about what at the monies or in the monies are, this is, whoops. Yes. So let's go with this. Oh, what happened there? Let me go back to this. All right. So any stock that's in this gray, these are in the monies. These are in the money stocks. Right here where it's trading is at the money. And then anything outside of basically at the money. So those are, these are all in the money. And then these are out of the money. Okay. And it goes the same for this. Right here is at the money stocks. And anything outside of that, these are out of the money. And then anything this way is in the money, okay? Because these puts are, trading higher than where that is. So obviously being below. So that's what we start out with. And another thing we're going to do is, I probably should have had the strikes here. We're going to be looking at, if I were to do this at the money, one thing we're going to do here is go over this real quick. At the money, it's trading $41 or as close to that as we can. Like I mentioned, we're going to sell this one right here and buy this one. That creates the synthetic short stock for EEM, which is just an ETF. You can do this for ETFs. You can do this for futures. You can do this for stocks, okay? And we can look at it. It's basically a 13-cent debit. It means that we're going to have to pay 13 cents for that, which makes sense because if I'm paying 13 cents for it, all right, and I'm doing the 41 strike, well, you subtract 13 cents from 41, and that gives us very close to where the underlying is currently trading. It's basically between the bid and the offer, very close. So it is very close to what we're doing. As a matter of fact, we're actually able to short this stock higher than where the underlying is trading, right? If I subtract 13 from 41, that gives me 87. Well, you can see the bid to the offer here is 74 to 82.5. Well, I'm synthetically selling this stock at the 41 strike minus the 13 debit that I got to pay for. Well, that means my break even on this, which I'm getting a little ahead of myself, but we'll go back over this, is at $40.87. That's higher than we're currently seeing the bid and offer happen. But now what I want you to look at is if I go out further in time. So remember, we did the 41 strikes there, and it was 13 cents. Same thing goes. I'm going to sell this 41 strike, buy that one there. Whoops, sell the 41. Usually speaking, this will come out very close to about the same. As a matter of fact, I've seen it even go lower. But you subtract the 44 cents from the 41, you can tell that we're at about $40.58. So my break even is slightly below where that is. But you can see that I can go even further out and try and go to the 41 strike even further out in time. And it's not going to get that much difference. Now, the puts have a tendency to get pumped up a little bit, and that's the ones we're buying. So that's why our debit's getting a little bit worse. But you can see that I've added over 100 days on this position, and it hasn't really increased the debit I've had to pay. All right, so in that, the duration, we want to go a little bit further out. It's not going to hurt us. So I'm going to try and pick about as far out as I can on this. But picking the right strikes is the at the money. Now, what John was referring to earlier, you guys, when we were given about the deltas. Now, delta is over here. So you can see this delta is 51. Well, if I go over to the look at the puts, it's a negative 48. All right. Now, if I go in here and sell 100 of the underlying, that's what I was saying. You are negative 100 delta. All right. So I could even let me look at something that's a little bit more, it's going to be a little easier to understand. Let's just look at deer for right now. It's going to have the same deltas. You know, you can see 53, 48. But if I go in here and sell this, you can see that if I go over to the, I'm selling 100 of deer. If I take this over to the Analyze the Trade, you're going to see over here, where's my delta? Negative 100 deltas. Okay? There's the delta line right there. It's saying negative 100. And that's because I picked the stock. Now, delta over here means for the calls, it's 53. Well, think about it this way. It's always thinking positive, where the market goes up, which means if the market goes up, these are negative deltas, all right? And that means for every dollar move higher, delta tells us for every dollar move higher in the underlying, these premiums are going to be affected by the same amount of delta, right? So this is 53 cents. So this means if XYZ goes up by $1, or deer goes up from 164.83 to 165.83, this premium will increase by 53 cents. All right. Well, what am I doing? I'm selling this call, which means I'm selling a positive delta. So a negative plus a positive equals, right, a negative. All right. So I'm selling that one. Well, I'm buying these puts, these corresponding puts, which means I'm buying a negative delta of 46, which means I'm negative 46 delta. Well, Now I've got both of these together. I've got negative 53 plus negative 46. I am going to show you that. Let me make sure, because every one contract in options is worth 100 of the underlying, right? So we're going to go over here and look at the Analyze the Trade. And you can see that my other position, the stock position is negative 100. My synthetic stock position is negative 99.5. All right. So you can see that building this out as a negative or as this position, that our deltas are the same. So let me see if I can copy the trade. Oops, I don't want to do that. I want to duplicate the order. I sell that. So if I go to confirm and send, you're going to see my buying power effect here is negative $8,000. So I'm going to have to put up $8,000 for that position. If I create the duplicate order there, confirm and send, you can see that my buying power effect is only 4,000. So half the amount. Plus I don't have to pay the maintenance fees and everything else on the, I'm not going to have to pay the borrowing fees on the stock, which is embedded in there that you're going to have to pay every single month that you're borrowing that. You're going to have to pay a fee to somebody, okay? And you can see that the way I have the Analyze tab up, the blue line is what happens if I just shorted the stock. The other line is what happens if I do it as an option. So you can see they run pretty much in tandem the entire duration of this, whether it's up or down. If the market goes up, I continue to lose money. If the market goes down, that's when I make money, right? Has everybody got that so far with the deltas? It's pretty simple, right? So if you're selling a negative delta, all right? And one thing to note when I was saying picking the right strikes and the at the monies, actually when I'm picking the right underlying, we want to make sure that, you know, less than, we move the decimal on deer 3 ticks to the left, 16 cents. Normally during open market hours, it will fit that rule. We check that rule for the underlying, picking the right underlying with the 35 days to expiration, despite the fact that we are looking for the duration, this duration, picking the right duration to be out on the timeline. So when we're looking at picking the right duration, you know, we talked about the right underlying. We're looking at inside of this area here, you know, to find out, you know, if it's less than, you know, 10 cents wide on that $100 stock, right? Well, we check that rule here, but then on this particular underlying, we're going to try and go out in this area. Why? Because it costs us the same amount, you know, or at least, you know, a couple pennies off here or there, but it's going to cost us relatively the same amount out here as it would inside of here. But I don't have very much time to be right inside of here, inside of 35 days. I only have 35 days to be right. Whereas out, you know, on the curve, you know, I have 100 plus days to be right. You know, so if you're going to be paying the same amount, you might as well give yourself that room to be right outside the curve, because maybe the market, you know, we've seen it before. You got a bearish assumption. You might just be early and it just trades sideways for a long time and then kind of falls off. All right. So that happens a lot where the market won't go your direction right away, but, you know, eventually it starts going the correct direction. Well, give yourself the room to be right. So we're going to be moving ourselves out on the timeline in order to be right. So give yourself as much time, the longer duration days to expire in order to be right is the way I look at it. You know, I like to go out, you know, 85 to 100 plus days. I don't usually go out 365 days. The reason why is because our bid ask way out there is going to get really wide. And, you know, I'll just pull up, I was going to draw an example, but I might as well pull up the platform to show you. You may have already seen that. You know, you can see here 43 days to expiration. Those right there, aftermarket, are a little bit tighter than even these out here. Now, during open market operations, these are going to fit the rule. These might even be 10 cents wide to the bid ask, but these might be about 20 cents wide to the bid ask. And the reason why it's okay to go out here when it doesn't necessarily fit that rule of the tight bid ask, eventually the eyeballs are going to be coming out here. Also, these markets out here are usually a little tighter than what you see with your eyeballs because people have different spreads on, and these markets aren't necessarily reflecting better bids and offers based on different spreads that people have on. So there could be stuff that is in the weeds, is what we used to call it, things you wouldn't be able to see. So, be aware of that as well. Now, the beauty in this one, picking the right environment, I usually talk about this as, implied volatility percent. We talk about IV percent a lot and trying to find out if it's high IV or low IV. Well, the nice thing here is we don't really have to worry about volatility, all right? And the duration, we don't have to worry about theta. So that was another thing I forgot to mention is theta is going to get offset as well. So we don't have to worry about theta decay. That's why it's another beauty in going out there. Even if you're paying a debit or a credit for these strategies, those are going to get offset because a product of what we're doing with buying and selling the same strikes is theta is the thief in the night that comes and steals our premiums, right? Well, it's negative to the calls, but it's positive to the puts. Well, it's always negative there, but if we're offsetting this, we're buying this one and selling this one, we're offsetting that theta, all right? The theta is not going to affect us. We're getting into this stock. If I'm paying 165, doing the 165 strike, and I pay 30 cents debit, well, subtract 30 cents from the 165, my break even is 164.70, and you can see that that's right in line with where the underlying is trading. It's a little wide because it's after the market, but you can see the last trade is 164.80. So we don't have to worry about that theta component because I'm buying the puts and selling the calls, so it's offsetting that theta. Also, the volatility. If the volatility goes up here on this one, it's 44. It's going to increase and decrease by what this volatility coefficient is. Well, it's offset by the same volatility coefficient. So, like we said, we're selling this. So selling the call gives us a sell to a positive theta, right? So that's negative. And then we're buying, Vega. We're selling, that's a negative to the Vega. So that's negative 44 Vega. And I go over here and I buy this strike, and that's buying 44 Vega. It's positive. So they've offset each other. So I don't have to worry about where volatility is in relation to that. Now, having said that, that means you can do it when it has super high implied volatility percent or super low implied volatility percent, right? But I would just say that if you're looking at really low implied volatility percent and you have a bearish market assumption, I would probably look at a different option strategy, all right? Especially if it's close to zero. Same if we're looking at a very high implied volatility percent, I would look at maybe selling, and I'm a bearish market assumption, looking at selling calls in that. Why? Because my probabilities of success are better with just a short call on a bearish market assumption, all right? This one, we have to be right away. If you did it in a really high implied volatility percent environment, we've done this already in this course. Selling calls would be a higher probability of success. Now, you won't get dollar for dollar on the down move, but your probabilities are better with the short call than here. This one, you are very sure that the market is going to correct to the downside, and you want to take advantage of this dollar for dollar move. All right, would you do this prior to earnings? Only if I had a bearish market assumption. So that is one of the downstrokes with this strategy, right? Is, we're doing that long duration. We have to carry it through earnings. Having said that, for me, and this is only my thoughts on Tesla, I think Tesla is overrated. And you guys hear me talk about Tesla a lot, only because it's easy for me to hate on Tesla, right? It doesn't make, I can go on my soapbox about Tesla. I don't want to change anybody's idea of Tesla. Some people love it. And then in that case, I hope for you that I'm wrong, but I'm always bearish Tesla. So for that assumption, I would probably write it out through earnings. Remember, we don't have to worry about a lot of strategies I talk about. I say, this one, you don't really want to ride through earnings, or you do want to ride through earnings. This one, it doesn't matter, because we don't have to worry about what happens to the volatility or the Vega, right? We know after that earnings, this Vega right here is going to get slashed. I mean, it's probably going to go, if we rode this through the earnings, this will get slashed to maybe 10 or something like that. So, you would lose a lot of premium value. Well, I've offset all the premium value. There's nothing to lose, really. I might lose a couple of pennies here or there, because I'm maybe 10 cents or something, but for me, that wouldn't really matter. So that is going to be a game time decision for you guys on this strategy. Would I ride this out through earnings? Most likely not, unless it was something I drank a big bottle of haterade on and was just believing that through the earnings it was going to go down. And if I believed it was going to go down, I probably wouldn't have wanted to necessarily, and I thought it was going to be a big move down, and I didn't want to write it out through earnings, and I maybe even want to write it out for a couple of earnings. If we're just trading it for that earnings, there's better option strategies to do it. That's, I will always mention those, if I was bearish for the earnings, then just for this earnings or in the next week or so, then I would probably go to the short call spread, or the short calls or short call spread. If it had really low volatility and heading into an earnings, I'm several weeks out, I'd probably be looking at buying puts for that earnings event. All right. But would I ride those long puts through the earnings? No. This one, though, you can. So if you're hating on some stock for long term, then this would be the most appropriate strategy for that long-term bearish assumption. Banu, did I answer your question there? All right, if you have a large portfolio of stocks, how can you hedge the portfolio with synthetic shorts? Well, for one, if you have a sector, you see the sector rotation happening, and say you're heavy into tech, and you see a sector rotation, usually the utilities start getting hit. Or right now, banks are on the hit list of things that people aren't loving. Why? Because interest rates are going down. Well, if interest rates are going down and there's, risk to the banks, which people have been saying there might be, then those banks are going to get hurt. So that would be a way to adjust that portfolio overall. Now, there's always opportunity in the markets, whether you're just looking at charts or whatever. But yes, most portfolios are delta long. It's because everybody goes out there and buys the stock. I like this stock, I'm buying it. I buy, and now I have a portfolio of all long stocks. Well, if you've had that, in the last week or two, if I can find SPY quickly without having to look this up, we can look at SPY or whatever. If you are all long stocks, and we look back since the beginning of the year, you really, have, let's just say since February to cherry pick, or April, the market hasn't gone anywhere, right? So if you're all long stocks, you're just feeling this whole thing. It's like 1 week you're like, yay, I'm so smart. And then the next week you're like, ugh, oh my gosh. Well, this is the type of scenario where you need to add some short deltas to that portfolio. Now, am I saying to do that right now? No, I think you might have missed it, but for the overall portfolio, you might have missed that. But you know, if you ever feel the market's gotten overextended and you have a portfolio of all stocks that are long, then you could go in and do the ETFs and do some synthetic shorts. Now, would I hedge, you know, if I'm long 5 different stocks, you know, 100 each, all right? So I've got 100 of XYZ, 100 of ABC, all right? You get my drift? Well, would I go in there and sell 5 of these and completely hedge the overall portfolio? That would be a delta neutral situation if I just sold 5 or 5 of the SPX, actually. Well, depending on the size of your portfolio. You know, that would be your delta hedge, right? So you could do that. I would say unless you thought the market was going to do just this and for the rest of the year kind of trade that way and stick right around the point of control here, and we're not going to go outside maybe even much of that, then yeah, make it delta neutral. And you'll be able to get out of it if it corrects and stuff. You know, if you thought it was going to really break down and you thought there was some systemic risk to the overall economy or that we're going to be in a recession and stuff like that, then maybe you would want to leave those stocks in there and get slightly delta negative. You hear about me and my portfolio, I'm almost always delta negative, despite the fact that the market usually has a tendency to go up. Why? Because, you know, I'm taking advantage of volatility and other things. So I'm getting short calls on market moves. I like to take advantage of these little corrections like this and little bumps. All right. So when it gets at all-time highs, that's usually when I'm looking to add some of that. So my portfolio has gotten a little bit delta negative recently. And as you watch today, if you watch those daily market commentaries, I went in and sold some puts in here in SPY because I was a little bit over negative in my portfolio, and we got this big bounce. The ISM for non-manufacturing wasn't as bad as everybody has expected, and we got the bounce. So, you know, I do stuff like that on a daily basis. I'm totally adjusting my delta portfolio. I'm looking at if I'm delta long, delta short, and I'm doing delta adjustments. All right. Sometimes I force myself to go out there and find something to be bearish about if I'm too delta long, or to be bullish about if I'm too delta short. Okay. And, you know, I would suggest you guys do that too, is force yourself sometimes to kick yourself in the pants to get some trades on. Because otherwise you get analysis paralysis. You just have to say to yourself, I'm going to do something today. All right. And I'm almost assuring you, especially when you have the probabilities in your favor with you trading the way that I taught you, you create probabilities that are in your favor, then, you know, those type of, you know, some people say don't force a trade. I don't necessarily believe in that. Sometimes I believe that you need to look at yourself in the mirror and say, you know, you've had analysis paralysis for 2 days. You guys notice on my daily market commentaries, I'm trying to take a trade every single day. I don't always. Sometimes, like, you know, heading into earnings season, or I just got off of vacation. I wasn't adding trades, but I was trying to force myself out of trades before I went on vacation. So, you know, forcing a trade to me would be like, I'm forcing my trade in SPY. I have to make a trade in SPY today. I'm not saying that. I'm saying, you know, if you're just looking for a trade to happen, all right? All right, John, did I answer yours? I think I answered you, Benu. All right, cool. All right, so let's then move along. I think I pounded that one into the ground. All right, so we've got the right environment. We've kind of offset all of those risks, right? So picking the right underlying, we've got this, you know, less than, I'm just going to say 10 cents wide to the bid offer, all right? Or, you know, move that decimal 3 ticks to the left. The right strikes is we want to create the deltas so that we are negative 100 deltas, all right? The deltas are negative 100. The right duration, we want to go out as far out on the curve as we can. We want to get that long duration, long expiry. Sorry, expiry. I tried to catch up with that. All right, long expiry. The right environment, we talked about this. We want to have that where we've kind of IV percent is kind of non-existent. All right. Somebody asked about earnings. You know, that's going to be up to you if you're going to ride it out through earnings. Usually with this one, you are long-term bearish. You know, like with me, I would be long-term bearish. And for an easy one to pick on would be Tesla. All right. And knowing your exit strategy before entering the trade. Now, this is really dependent on your risk parameters. All right. Now, I have a lot of friends that do time on these. Okay. You know, in 3 days, if this does not go in my direction, I'm out of it. I'm pulling the ripcord. I don't have a problem with that. Another thing would be if I got into this and I was short wanting to be short SPY, I would say, you know, if it goes above, you know, this Fibonacci, if we get above this Fibonacci here, that's where I'm out. So basically, I'm looking at 196 or 296. It goes above that, I'm canceling out of this trade. All right. Also have your profit target. You know, if you're bearish on this, it comes down to the 38. You know, this is where my profit target is. Don't be stuck with that. If it comes down and bounces off there, don't be afraid to get out of this trade at a profit at any given time. If your assumption changes, get out. All right. If you get that inclination where all of a sudden it crosses your mind, maybe I should get out of this. You know what that means? Is yes, you should, because it's your limbic brain, which can't form sentences or form words. It's that gut feeling. It's what everybody talks about, a gut feeling. You get a gut feeling. That's your limbic telling you guys something. And I always say, go with that gut feeling. Why? Because your limbic brain can process so much information that you can't comprehend. And it's trying to tell you what it's come up with, but it can't, because it can't signal words or form pictures or anything. All it can do is just give you that weird feeling like either you're right or you're wrong. Okay. So go with that. All right. Do you think we should also do put protection? I wouldn't do the put protection. That brings up, because you're long those put, I wouldn't have to add those put protections, because that's going to really kind of add a little bit more, or it's going to limit your risk there. But one thing that thank you for asking that, because it reminded me of the one that there's my short puts that we were talking about. Let's just find something, Cisco. Let's just say we're bearish in Cisco for lack of any other thing. What I was talking about with this, since we are doing this short, right, we're selling 51, so we're negative 51 deltas, and then we go out here and we're buying this, so we're getting short 49 deltas. That's a total of 100 deltas. That's equal to the underlying. We can figure out what our break even is on this by subtracting the 38 cents from 57.50, and that gives me, I'm getting short this at 47.12. So you can see 47.12 is basically above where the market's trading. So that's good. If you are doing this in an IRA or whatever, and you want to create this exact synthetic position, I usually go out and buy the call that I can buy for about a nickel. Now, I will tell you, if this market's going against me, I am not writing this out to Cisco being $70. I'm going to be out well before that. You know, I would go out and, you know, do your drawings just like anybody else. And maybe it's Fibonacci or whatever, and throw that out there. I would probably be out on this one at $51. If it started breaking above that, then, you know, that would be where I would say my out is if I was bearish. And if I was bearish in this, I would probably think my profit target is going to be down here at around $40. I would look for it to go down and test the bottom or down in here somewhere. So if I were bearish in Cisco, right? So I would throw stuff up like that. Or, you know, if it broke above this high here, you might say, you know, maybe you don't use Fibonacci, and you're just like, all right, well, the market has a tendency to, like, we've gotten this big move, you You got your correction. Maybe you think it's going to be a bounce. Well, then if it breaks above this area, then I would say I'm out, because you're getting that higher high now. It's, however you come up with your assumption, right? Yes, the limbic says stop screwing yourself. So the dog ate your option homework. Comcast Tech, tweak the cable modem software, expensive modem, Greater Houston area, to work properly this afternoon. Good to hear. Sorry about your dog eating your homework. I guess your homework had to be your computer at this day and age, right? Good to see you back in town. I love, or back on these webinars, Rick. Missed your snark. All right, so let's go over quick before we get over this. Our risk parameters, right? We talked about this. Your max profit is achieved when the underlying goes to zero. Are we ever going to wait till it goes to zero? No. We're going to look for areas to get out. Now, it's going to be up to you. This is also me, telling you I can't give you advice on what to trade, right? You need to know what your risk parameters are. What would you, if you got short a stock, where would you want to get out? All right. And if your limbic tells you to get out, get out. But to know your profit is when the underlying goes to zero. And again, your max loss is infinite because this can go, you could have GE all of a sudden discover a cure for cancer or something, not that they're even involved in biotech, but and all of a sudden is worth more than Google or Apple. It's the most expensive stock market cap in the world. So you need to know that it can go to infinity and beyond. And our break even is, I think I've gone over this a couple of times, it's your strike price plus the credit or minus that debit, right? So if your strikes are above where the underlying is going to be, so, if we're looking at something like what we were looking at, the underlying is trading $40.78. Let's just say that's XYZ. And I'm doing the 41 strikes, right? Well, it's 41 strikes minus probably that, 22 cents or something. All right. Well, then my break even is $40.78. Right? Now, if I'd done the 40 strikes, what if I'd done the 40 strikes? Well, then I'm probably getting a credit of 70 cents. All right. So then I would have to add that 70 cents in and it'd be very close to there. All right. So usually if you're doing these calls that are slightly in the money, you're going to be getting the credit because you're selling something that is going to be worth more than the ones that you're buying. So usually if you're picking the strikes, and I usually like to pick those strikes, the short call strikes just out of the money or just slightly there, they call them, I call them at the monies. Everybody calls them at the monies really. But, like in these examples that I was looking at, you notice that I defaulted to the ones that were just usually slightly out of the money on the short calls. I was looking at these and then buying these. So in that case, I'm almost always going to be doing that for a debit, right? Because these are slightly out. But if I would to have done these strikes at the 45s and sold those and bought these, you're still getting very close to 100 deltas, right? Negative 61 plus negative 38 is giving you 99 deltas. And it's going to be very close to the same break evens, but you can see now I'm getting a credit. So I can add that into the 45. So that gives me $47.15 is my break even. All right. Anybody else have any other questions on that? Pretty simple, right? I mean, it's a simple one to get involved in. I just want to make sure you guys have all of the details so that you don't have to worry about that. Like I said, if you want to, have really high implied volatility, go with a strategy that has a little bit better probabilities. All right, this is our deal, our course. You get all 4 courses for $299. $97. Basically, you get the volatility crush. This will really help you understand volatility like nobody else. I mean, I'm telling you, guys on TV, even friends that were mentors of mine back in the day, don't understand volatility and or how to trade that volatility. You know, they're all talking about, and that it also has to do with, you know, what they are allowed to say on TV. And, you know, the rule makers say you can't talk about shorting calls and shorting puts and stuff. There's too much risk, they say. Well, if your probabilities of success are much better with that, then why is that more risky? I don't get that. But so volatility crush will help you understand it. I talk about historical versus implied volatility, how to calculate that volatility crush so you know what's going to happen going forward. Usually we charge almost $1,000 for that. Trader hacks. This will help you sleep at night. You know, this gets you your Z's. And then this one is going to streamline your process. This is basically Lean Six Sigma. And will streamline your process. You get trading shortcuts, learn how to trade options the right way. Floor trader hacks. There's 9 different floor trader hacks that we've got in there. Things that we used to use on the floor to streamline that process. Basics, if you've gotten lost a little bit or wanted to learn more about some of these basics, this one's a great one for that one. You should take advantage of it. You know, all of these separately, if you didn't watch one of these webinars, would cost you an arm and a leg. But we're giving you it all for less than $100 each. All right. So learn to trade options, basically setting up your screens like I do, your option montage, your watch list, all of that stuff, so that when we go in through it, we can take advantage of it and have to even day trade using Gamma and all of those things. So take advantage of it for $297. You guys, this is over there in the chat window. We've been going back and forth through the questions box. I've been reading those there. You'll see over there in the chat window, there's a link. If you're watching this on tape delay, you're just going to have to pause right now and type this into the URL just like that, with all the forward slashes and everything else. And finally, I want to thank you guys for participating in this. When you guys go back and forth with me, it makes it go faster for me. I make sure that I understand you guys are clear concept, so I appreciate that. Also, in later webinars, we'll be drilling down on different option components when and where I find those appropriate. Here again is that link that you're going to have to, if on tape delay, type that into your URL. Hopefully you guys in this webinar right now are just taking advantage of that link over there in the chat window. And if you have any questions, reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. All right? So take advantage of that. It's a great deal. And I see a couple of questions, I think, coming up. How is the risk difference if you receive a credit versus a debit? It isn't any more risk difference. One thing, I mean, one could say that if you're selling that call that is slightly in the money, you know, you could immediately get exercised on that call, right? Which means, you know, now you're really short the stock. You're not synthetically short the stock. The offset of that is you have those long puts, though, that you can then put that stock to somebody else. So that would be something you wouldn't want to get involved in, because then your costs start going up, right? One of the beauties in doing it with the options is we pay very little commissions. And, you know, with the way things are going, we're not going to be paying any commissions at all. Quote unquote, you won't be paying commissions. I can go on a soapbox about how they're actually making more money by not charging you commissions, because they're selling your order flow to the high frequency traders that are just getting better price than what you are at that point, you know. So it's really not, you're not necessarily being benefited by no commissions. It's a misnomer. Just like Robinhood said they weren't charging commissions. Well, it's because if you want to buy the stock on Robinhood, you are paying a higher price than you would had you gone to the New York Stock Exchange itself and bought the stock on that exchange. All right. They're showing you prices that are worse than where you could get somewhere else. So they're scalping you, is what we used to call it on the floor. There's arbitrage they're taking advantage of. They're actually creating arbitrage. in that situation. So there's no free pass in life, you guys. When they're saying it's free commissions, it's because somebody else is paying them a lot of money for your order flow. That's my little soapbox there. But what about dividends on the short calls? Great call, great question. One thing with a short call, or if you go out there and synthetically short the stock, you have to pay that dividend. That's also another problem with that, is you're going to have to pay the dividend out. With this one, there's no dividends on that. If you're talking about dividend risk, the market usually goes down, or is expected to go down by the amount of the dividend on the ex-dividend date. So, if somebody's giving you a 40-cent dividend, the stock is supposed to drop by 40 cents on the ex-dividend date. It doesn't always happen that way. But the underlying going down will help this position, and those calls should dwindle in value, but you never have to pay the dividend on a short call. All right. Tasty Trade's better for actual execution. I don't know. I don't know anything about them for the trade executions. Other than, you know what? I have heard about them. They charge to get in, but not to get out or something. If that's the case, then they're probably charging you more to get in than to get out. Everybody's right now trying to come up with all of these fancy ways to get your business. All right. For instance, Schwab was the first one to jump on this. All right. And since we're talking about it, I'll talk about it a little bit. Schwab, 57% of their net income, you guys, is based on your idle cash sitting in your brokerage account. So if you have idle cash in your brokerage account, what happens is those guys loan that out to banks. All right. So they collect interest on those idle funds. All right. And Schwab's got 57% of their income based on that. 8% of their income is based on the actual trading commissions. And then it's like 37% or 30 some percent is on their asset management, but they also get like 15% on selling order flow. So that means on the big trades that happen, or they bundle it. So for instance, they call up all their clients and say, hey, you should get into Coca-Cola, and they get, 10,000 people or 10,000 shares of Coca-Cola they need to buy. Well, they sell that order flow to Citadel. And then Citadel says, I'll sell you that Coca-Cola at, I'm spitballing. I don't know exactly where Coca-Cola is trading. I'll sell you that Coca-Cola at $50 for all 10,000 shares, right? Fine, done. Everybody from Schwab bought Coca-Cola at $50. What does Schwab or Citadel do? They goes into the New York Stock Exchange and buys it for $49. So they just made $1 on 10,000 shares. Well, you didn't pay any commissions, you guys. You didn't pay that, $7 commission, but you just lost $100 in getting scalped by not paying commissions. All right. So that's how that whole thing works, is basically they sell the order flow to somebody that takes a little bit of risks and goes offsets it on the actual exchange. All right. So you didn't pay any commissions, but somebody else got paid. So those are oversold and at value to buy. If we're talking about the synthetic stock positions, those I would like to get these when they're over, got into an overbought type of situation. Oh, brokerage firms. Yeah, they could be. To be honest, like I said, 8%. Schwab is not worried about 8% in trade commissions, right? All they want you to do is put your money in there and forget about it. They don't even want you to trade. They want to just make 2% a night. They make the money on they make their biggest money on those idle funds, and they on the order flow. So especially when you get into big companies like Schwab, I would say TD Ameritrade's not really selling order flow necessarily, unless it's they're their brokerage guys are calling you up, or you deal with the brokerage guys that call you up every once in a while and say, hey, hey, our analyst came out and said this is a buy or this is a sell, and all of that stuff. What they're trying to do is get as many people in at one time to come in and buy and say, yeah, I'll buy it. I don't care. They're not getting what they do. What do? They'll say, all right, I'll call you back with your confirmation. Right? All right, you bought it at $50. Congratulations. Well, Citadel bought it for $49. Thank you very much. You always buy stock with synthetic stock. That's the way to do it. If you don't care about dividends, or if you're not going to be in it for the next 100 years, and you're more of a short-term swing trader kind of thing, this is the way to do it rather than going out there and buying the stock. All right, well then, without further ado, you guys, appreciate that. If you can't take that, take it easy.